Live. It's time now for the big picture. Let's welcome in Collin Martin, who is the Director, Fixed Income Strategist, Schwab Centre for Financial Research. Thank you so much for joining us. Happy Friday to you, Collin. So how are you and your team thinking this week about the lack of data we've been getting, and then also about some of the data that we have got and what that's actually been telling us?
Yeah, it's been an interesting week for sure, where we still have some data. I think that's important to highlight that a lot of the key releases, like today's jobs report, which is, I think, very important given that, we're kind of at this turning point or inflection point. But we do have other data. We did get the ADP employment report, which usually doesn't get as much of a focus as the labor market report. But given that we don't have the standard releases, we do have to pay attention there. And that showed a bit of weakness. We saw, 3 out of the last 4 months saw job decline. So that's not a step in the right direction, because I think that's really what we're looking at. And I think most strategists, most Fed officials are looking for in terms of the outlook going forward. Is the labor market softness continuing? Is it accelerating, or are there signs of stabilization? And just looking at that ADP report, it looks like maybe it is weakening, but it would help a lot if we got a bigger picture, especially with that BLS data.
Okay, but stocks keep continuing to hit record highs, and as far as the pricing in is concerned of expectations around rate cuts, I mean, it's pretty much baked in at this stage that we're going to get one in October. So what does it mean? Does it change the narrative as far as the data that we have been getting for the markets and the Fed?
It doesn't change the narrative just yet. If we look at the Fed specifically and we start there, they cut last month, and what we focus on is that there's this wide dispersion of views among Fed officials, but there is, a decent amount of support. More than half of the committee members were pricing in 2 cuts by the end of the year. So there's a lot of support for a move lower. And if you look at the Fed funds futures market right now, implied probabilities, there's a nearly 100% likelihood of a cut later this month. That's not necessarily our prediction, but that's what the markets are telling us. In the absence of data, and maybe we'll get the jobs data by then, who knows how long this shutdown will go on, the Fed policymakers will probably look at the trends, and they saw that the labor market was softening. And there's probably enough people in there that think that maybe they can cut one more time at this meeting, given their projections. Looking ahead, though, there really is a lot of uncertainty. Inflation's still really high right now, despite the cracks in the labor market. The economy appears to be holding up pretty well. We got revisions, the final revision to the GDP, and it came in really strong, well above the first estimates, well above the second estimate. So despite those concerns, the market's holding up and the economy's holding up. And I think there might be some pause for committee members about cutting too much in an environment where the economy's growing and inflation's too high. So we do think there'll be another cut this year. After that, though, we'll have to see how the data plays out.
Okay, so you seem to suggest that I hear what you're saying as far as, maybe not as many cuts because of the fact that they do anticipate that we're going to see growth holding up. And some are actually saying that we're going to perhaps even see an acceleration next year. We've had Laurie Logan out this week sort of suggesting that maybe we should be approaching with some caution. Austin Goolsbee, I know that he's been speaking also in recent days too. I mean, he has previously said that he's perhaps worried about the next course of action because of the inflation picture as well. Are you surprised then at just the reaction function of the markets and the pricing in of, further rate cuts for the rest of the year?
We are a bit surprised by that, and we for now we disagree a little bit with what that path looks like. If we use implied probabilities from the Fed funds futures market, they're pricing in almost 2 cuts this year, and then a rate in 12 months of less than 3%. And that just seems a little bit too low, given the points that you just made, that one, the economy is holding up. And it's possible that it can pick up a little bit from here, even with those labor market cracks. We have, expansive fiscal policy right now that can boost growth over the short run. And when we hear those comments from various Fed officials, you mentioned Goolsbee, he's been very vocal, Lori Logan, others are a little bit hawkish as well. And I think it's important to listen to how they're approaching it. And I think they're being humble about it, and they're acknowledging openly and transparently that there are a lot of risks here. There's risks to inflation staying elevated as much as there's risks to the labor market cooling, and they need to take a very measured approach. So that's why we disagree a little bit with those, somewhat aggressive implied probabilities of a rate of less than 3% next year, because we kind of say, hold on, let's wait to see how things evolve. Because if the labor market does stabilize and inflation kind of remains where it is right now, there doesn't appear to be a need to cut as aggressively as the markets are currently pricing in.
Okay, point taken. Collin Martin, always a pleasure. Thanks so much for that. Have a great weekend. That is Collin Martin, Director Fixed Income Strategist, Schwab Centre for Financial Research.